Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the TGI. TGI, thank God it's Friday, the 10th of November, Bull versus Bear webinar. Steve Miley here on the Call for Trading. Welcome, everyone. We're going to go for our usual regular run through in here today. But before I get into that, just to apologize for the lack of webinars the past 2 days. My apologies. Personal circumstances from my side, we struggled to get actually any cover to do the webinar, because we just want to give you someone who's quality rather than just getting anybody to do it. James is very, very busy at the moment, so we didn't manage to find someone to cover the webinars for me, and I had some personal stuff going on whereby I could not get on the webinars. All is good now though, and I'm back with you today. So we're going to look at our regular stuff in here today. I'm going to actually start off with some of the reports. Just to give you a little bit of a background on why I think the reports are important, and why what some of the price action we're seeing in some of the charts, and relative to across the different asset classes, how they're correlating together. And then we're going to take a look at so we'll look at that first of all. Then we'll take a look at some articles from the major newswires. We'll go through the calendar articles. What are the major financial market, the central bank, the geopolitical, the macroeconomic data events, the fundamental events that are influencing financial markets right here, right now. We'll take a quick look at the CME tool to see where interest rates are pointing us and how that's reacting on the short end. And then we'll take a look at some of the charts. We'll have a look at where also where markets are overnight, and then we'll take a look at some of the charts in a little bit more detail before we finish off. Any questions you have as we go through, please do feel free. Don't wait to the end to put any questions in. Put the questions in as we go. Right, the first thing I want to focus on really though is the this correlation we've been talking about for weeks and weeks, months and months in fact, in here between the bond market and the equity market. As I've said previously, the bond market is very much the dog that's wagging the tail of the equity markets. Very much a lot of the time, the equity markets, the stock indices, the stock markets are the driving force of financial markets. But sometimes other markets take over, whether it's the FX markets and the dollar, maybe sometimes it's commodities, what's going on with maybe the oil price or the gold price. And in this case, it's the bond markets. And the bond markets have really been the markets that everyone's been watching. I speak to my colleagues, my ex-colleagues from the institutional financial markets world. And if you see there's been loads of articles written about, the volatility in the bond market and how the bond markets are more interesting. So we're seeing a lot of that going on in here, a lot more interest in the bond markets, and they have been the driving force. And what we've really seen in here more recently is this move. Well, the big move lower. We have spoken about this before. The lower in price on the bond markets equals higher yields. This in here, this lower price, higher yields, has got the market to think that the bond market, as they say, is doing the dirty work for the Fed. Okay, in that this is higher interest rates, higher long-term interest rates, and that means maybe the Fed would not have had to hike rates. More recently, though, in here, since the mid to late part of October, bond prices have been going up, so that means yields going down. And that means then not only is the dirty work been done by this move here to higher yields, but this move back up into higher prices, lower yields, has meant that stocks can rebound, because the stocks like lower yields, like lower interest rates as well. So you kind of got the stock market's kind of doing the equity market a favor in that this move down in price, higher yields, has meant that maybe the Fed are going to back off. And then because the Fed are backing off, that's positive. And then the more recent move to higher prices, lower yields, that's also positive. And so you've seen a positive correlation. We saw this move down in price and then up since October. If we jump to the index chart, it's kind of similar in here, right? So we've had the market down from August and then popping higher from late October, okay? What I really want to focus on, so this is the S&P. So what I really want to focus on, though, today is the moves that we're seeing in the last 24 hours. So in the last 24 hours in here, we're seeing a significant move down, and we saw this again earlier in the week. We saw a significant move down in price, higher yields, okay? And then subsequently we went back higher then, okay? And then we saw another move down in price, okay, which is higher in yields, right? So we've seen that happen in here on two occasions, okay, over the past week, okay? And what's interesting for me in here is, despite this move, both moves we had in here, down in price, okay? The one earlier in the week, I forget which day it was. I think it was Monday or Tuesday. yesterday. We saw down in price, and then we saw down in price again. When we've seen both these moves down in price, we haven't seen, if you go and look at the indices in here, the indices have just been up, 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 up. And yesterday we had the slightest dip back lower, right? Whether you look on the S&P, the NASDAQ is a little bit more interest rate sensitive. So you saw a bigger move down yesterday in the NASDAQ. And then back in here, you can just, if I zoom in a little bit more in here, you'll just see in here, we did get a slight, very, very slight dip earlier in the week. But when you had that more significant dip back here lower, okay? So what I'm trying to say in here is, even though there's a positive correlation, yeah? So when bonds have gone down in price and bonds have gone up in price, stocks have done the same, okay? Stocks went down in price and stocks went up in price. So there's a positive correlation. And from my perspective and from many people I speak to, it's the bond market driving the equity market. So we're keeping an eye on bonds, okay? Bonds are kind of leading equities, okay? But what we've seen in here over this past week, when bonds have gone down, okay, stocks haven't really gone down, or they went down yesterday, but it wasn't a huge amount. So what that shows is the underlying resilience. What I mean by resilience, a more solid, positive tone to stocks relative to the bond markets. So even though bonds went down, stocks kind of held in. And if we get any kind of rebound back higher in here, if I go back to now, the bond market, if these bond markets start to rebound back higher, which they have slightly this morning, that could open the door then to higher prices for stocks. Okay, so if we see a rebound in bonds, looking for stocks because they've been very resilient, this is what I would call in here high level consolidation on the S&P. We had a really big push up higher, and if we go and take a look, so let me just come off of this in here. Just going to jump to the charts, going to jump around a little bit in here today. But if you look at the S&P in here, this is what I would call high-level consolidation. Yes, we were down lower yesterday and had a little bit of a dip in here overnight, but it's only in relation to this big up move. And we step into like a 30-minute chart. Yes, it's gone kind of sideways in here, and it's been slowed down on the ascent, and we had that sell-off yesterday. Did take out a little bit of support in here, but it's holding in relatively well after this really strong rise. Remember that the market put in the S&P yesterday broke an 8-day winning streak. It was up 8 straight days. It hasn't done that for 2 years, okay? 8 straight days. So it's a really forceful move we've seen here over the last week and a half. So a dip back lower. This is a relatively small dip considering this really, really, really strong rally in here. And yes, we did break the trend line in here. So you had if you look at the trend line that comes up through here, but it's a sideways break of the trend line. So I'm just going to extend this to array, apply, save. Okay, so we're just breaking this trend line. We're flirting with this trend line, right? But if the bears were going to take control, the bears took us down lower yesterday. If they wanted to take control, they would have been hitting this trend line and breaking it. You can see it kind of nudged at the trend line slightly, came back away, broke it again, kind of on a little bit on the overnight, and now rebounding. The market doesn't want to get down. The bears had a great opportunity last night, and then so far today. Now that we've yet to open yet. So when the cash market opens, maybe we get a bigger push lower in here. But at the moment, the market doesn't seem to want to really reverse lower. And as I say in here, we are seeing bond markets. If I jump to the bond markets in here now, okay, so we did get that push down lower in price. You can see the bond market is rebounding in here at the moment. Okay, this is a 10-year note future. And what's interesting as well, look at that 13-day moving average. Okay, that 13-day moving average was a good resistance indicator through here. And now it's acting as support. And we've gone right close to it yesterday. Overnight, we've dipped just below. And look, we're rebounding. So bond market is rebounding. That should open up potential upside. And you can see it on the yield chart. If I jump to the yield chart in here, pop that out 1 second. So you got the bond market went back to higher yield yesterday, but look, reversing back down to lower yields now. Those lower yields should be supportive of vectors. So it's setting up for me relatively positively in here on the stock indices going into today. And just going in here, again, you can see, look, there's that sell-off yesterday, and look, popping higher in here today on my trading view chart. So yeah, overall for me, the markets look shaping up going into today. The bonds are looking a little bit more positive, and stocks, even though they sold off, even though they've not really had a decent rebound in here, they didn't sell off yesterday. So all of this is looking relatively positive for me going into today. So I just wanted to get like those kind of technicals out of the way first of all, because obviously yesterday, I just running through, I'll quickly do the calendar, but the calendar's very, very light today. We've had UK GDP out in here this morning. You can see most of it is in green, the GDP, so beating expectations. I've got a quick little article on this. So UK staves off recession, recession. I'll start again. UK staves off recession threat for now with stagnant quarter. So even though the UK flatlined, it was better than predicted. Okay, so you can see in here, kind of flatlined in here. Quarter on quarter, it was 0. Expectation was minus 0.1. So we're missing recession just. Technically missing recession. But equally, better than expected. Industrial production and manufacturing production slightly worse than expected from the UK. But the UK, as we know, is not looking quite so good in here. Then down, if we look at what we've got coming up today, we get Bostic. So 9 a.m. Eastern time. Bostic is speaking, watching out for that. We do get ECB President Lagarde speaking today at 7:30 as well. Lagarde rarely has a significant impact on markets when she speaks outside of the ECB meetings. Bostic speaking later today, though. And then at 10 a.m. Eastern, we get the Michigan Consumer Sentiment. Don't forget this. It comes out on a Friday. People often forget that it comes out. That can sometimes move markets. So watching for that later today as well. Comment from Rufus. Thank you for going over this breakdown. Me struggling to grasp the impact of Treasury notes and bonds. Okay, hopefully that works for you. That gives you a bit more insight in there. Basically, there's a positive correlation, as I said there, Rufus. Yeah, positive correlation. And what we're seeing is an underlying resilience. Now, yesterday, if you had sold stocks because bonds were going down, you might have done okay because obviously stocks did go down, but they didn't go down a lot, right? So there's been an underlying more positive, more resilient tone for stock indices when we've seen these sell off in bonds. If we see bonds rebound, I would certainly be looking at that as more of a bullish signal. If they sell off, it's not necessarily as much of a bearish signal. That's the way the market is reacting at the moment. Okay, so we had that UK numbers in here. We've got Michigan Consumer Sentiment and Bostic speaking later today. There's the UK numbers. And if we look in here, the driving force, obviously, on all of this, the reason we went back to lower prices in bonds, which are higher yields, was Powell. Powell was certainly, right? The market has got itself now in a point of they're not going to hike rates anymore, okay? The rate hikes are done. They're looking for the first rate cut. How soon can that come? And we've been looking at the CME tool, and then we've been looking at maybe May, June for the rate. The first rate cut, and it's moved from June. More recently, we looked at it, it had gone to May. It's actually pushing back out. We'll come to that in a minute. But also, we're looking for no more rate hikes. Okay, the market's almost discounted in that there's going to be no more rate hikes, even though the Fed at their last meeting said there might be. There's a good chance there's going to be another rate hike. Okay, but then Powell yesterday was certainly. He didn't give the market that dovish tone. He gave them slightly more hawkish. So look, a slightly exaggerated market reaction to Fed Chairman pushback against early US interest rate cuts. Okay, so that kind of burst the bubble. So it had its 8 straight up days. The S&P was down yesterday. Obviously, bonds went to lower prices, higher yields. Okay, so that was the main reason why we saw those moves yesterday. And also in here, where are we? Yes, stocks fall as central banks push hawkish message. Okay, so Bostic, Logan speaking later today with Lagarde, and obviously we had Powell yesterday. 5 things to start your day. Let's just run through this. Remember, you can go and access this if you're new to the webinars in here. Oops, wrong page in here. If you go to the homepage at Bloomberg, over here on the right side, so bloomberg.com/markets. Go to bloomberg.com/markets. I'm going to share that in the chat. It's in the chat now. Over on the right-hand bar in here, enter your email address. You'll get an email in the morning. Whenever your morning is, it's done. It comes out 3 times a day. Asian, European, US time. Okay, so it comes in your, I usually get about 6 a.m. my time. It comes out about my time 11 a.m., which is I think 6 a.m. New York Eastern time. Okay, so basically it's coming out around 7 a.m. depending which time zone you're in. There's an Asian version, European version, and US version that gets updated. Okay, so do sign up for that. It's a useful resource. Okay, you can also Google it. You can find it in here if you go over here and type in 5. Okay, but, see that I type in 5 and it takes you to 5 things. Where is it in here? You can find it as well. But often it's on that front page. So 5 things in here. You go down, there it is here. 5 things. Okay, you need to start your day. But where are we? Let me go back to the actual one in here. So here we are. Fed fallout. So we're speaking of that. Stocks are falling on Friday in Asia and Europe because Powell was a little bit more hawkish, okay, and less dovish than maybe the market had hoped for. Speculation, Democrat stalwart Senator John Manchin, who said Thursday he won't seek re-election next year, could emerge as a third-party candidate in the election, okay, but not really impacting markets in here. Israel, Gaza, not really impacting markets. And futures overnight in here flat, and this running through the data that we've already spoken about, University of Michigan data. We've got Laurie Logan speaking as well today, and Bostic we've already mentioned in here. Oh, and Daily as well by looks of it speaking, but they're not on the calendar. Speaking on CNBC. Okay. So that's what we've got coming up today. Stocks full. We've already spoken about that. Futures mixed overnight, so kind of flat overnight after Powell's slightly more hawkish tone. Awaiting data. That's the Michigan data. Okay. Let's look at the CME Fed tool in here. 90%. This has been hovering at 90% for the December meeting. Okay. So I'm expecting no change. Very, very unlikely. Only less than a 10% chance we get a rate hike. There's more of a chance the market is pricing at the moment. Just about an 80% chance of us being unchanged by January. More of a chance, nearly a 20% chance, just over a 20% chance that we get a rate hike in January. And before, remember, we'd seen the first rate cut. This was higher, right? This was just higher than this. This is unchanged, 525 to 550, okay, for May. So we're looking at the rates to be unchanged still in May with about a 40% chance of a cut, okay, and a very little chance that we're going to be higher than here, okay? But this was actually higher before, that we had a bigger chance of a rate cut in May. That's been pushed back because of what Powell said. If we go to the June now, we now see 500 to 525, which is the rate cut compared to where we are now, 525.50. We're looking for that cut now to come more likely in June. So it gone from previously being June to coming in over about the last week and a half. We've seen more hopes of an early rate cut for May. Now it's been pushed out on the curve in here. Remember, this is based on the Fed 30-day Fed funds futures. So this is basically the interest rate curve for the futures markets. Okay, so showing now more of a chance of a rate cut, yes, in June rather than May, but still very little chance. We go back to December in here, very little chance of us seeing a rate cut in December, rate hike in December, and more chance if we're going to get one, but that rate hike now comes in January. Okay, we're kind of run through, just having a quick look on the overnights. Basically, Hang Seng, China market, offshore China market in here followed US stocks down overnight, playing catch up. Nikkei wasn't down too much though. Europe also down this morning, playing catch up on the downside. The FTSE over 1%, 1.3%. The German DAX, it's the UK FTSE. German DAX about 0.8, and the French CAC 1.15% down this morning. But if we look on bonds in here, US futures in here pretty much flat in here overnight. The Dow's actually up slightly, the S&P pretty much flat, and the Nasdaq just very slight by 1/10 down. So Dow up 1/10 and Nasdaq down 1/10, having suffered some losses between 3/4 and basically just over 1% down across the major indices, not showing them all in here, but down yesterday. I've already kind of looked at the charts. I'm bullish. You can tell I'm bullish in here, guys, right? So just going back to the charts in here, I'm still playing this from the long side. Okay, so wrong one on the stock indices in here. So if we go and look at the ES, first of all, in here is flirting with this trend line. If we cut below the overnight lows, then we could easily see the ES move down to here, 43.26, and look for support to come in around this area here. Okay, on the top side, if we pop above the overnight peak in here, that's at 43.73. It certainly is shaping up more bullish for me. Similar story with the Nasdaq in here, got a little bit more damaged yesterday. There's a big deeper sell-off in here. I'd be looking through the overnight lows, so down through like 15.200. It looks vulnerable for a move down to like 15.130, but would look to hold there. Above the overnight highs, above like 15.275, it looks more bullish. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. I'm going to wish you all a great weekend as well. Stay safe, take care, and I'll be back with you on Monday with another bull versus bear webinar. Bye.